It's been a pretty quiet year for the TSX overall, with the index barely up, gaining less than 1% through the first 4 months. But don't let that headline fool you. Beneath the surface, some individual stocks have been crushing it, posting gains north of 20% since the start of the year. So today, we're counting down the top 5 TSX performers as of April 30th. Each one has outpaced the market in a big way, and we'll walk through what's driving those returns and what you should watch for if they're on your radar. Let's dive in. Kicking off the list is Dollarama. It's up 21% this year, proving that even in a shaky political environment, value retail can deliver serious returns. The company's been a go-to for Canadian shoppers looking to stretch their budgets, and investors have taken notice. Dollarama's model thrives on predictability, recession resistance, and minimal exposure to international risks. That's a pretty compelling combo when markets are unsure. Their same-store sales have grown nicely, driven by people spending more per visit. Add in strong cost control, a growing store count, and insulation from the e-commerce threat, and you get a retail name that's still expanding. Now, it's not cheap. The stock trades at 41 times earnings. But with revenue up nearly 50% over the last 3 years, Dollarama continues to earn its spot as one of Canada's most reliable growth stories. Just don't expect a juicy dividend. It yields only 0.25%. Next up is Nutrien, with a 22% gain this year thanks to renewed optimism around agriculture and commodities. Nutrien's the world's largest potash producer, and as global demand for food security ramps up, this stock's gotten a tailwind. Add in positive sentiment around infrastructure and trade under Trump's return to office, and you've got a solid setup for a commodity recovery. What makes Nutrien stand out is its size, reach, and vertical integration. It pulled in $26 billion in revenue last year, with profits of $674 million, and analysts expect that bottom line to grow, bringing its forward price-to-earnings multiple down to a much more reasonable 15. It also pays a solid 3.9% dividend, which is hard to ignore in this market. Coming in at number 3 is Maple Leaf Foods. It's up 24%, thanks to its dual appeal, steady meat sales on one side, and bold bets on plant-based protein on the other. The company's been quietly transforming itself, modernizing operations and automating production. That's led to better margins and operational gains, even while its core business holds steady. The plant-based segment is still small, but it's positioned nicely for the shift toward more sustainable and health-conscious eating. Between that and its legacy brands, Maple Leaf gives investors both consistency and innovation. At 32 times earnings, it's on the expensive side for a slow-growth name, but with a 3.9% dividend and strong brand recognition, it's attracted those looking for a dependable consumer stock with future upside. Next up is Wheaton Precious Metals. It's the second best performing stock on this list. Wheaton Precious Metals is up a massive 42% so far this year, riding the wave of gold and silver momentum. But here's the kicker, it's not a miner. It's a streamer. That means Wheaton doesn't dig the metals out of the ground. Instead, it pays miners up front in exchange for the right to buy a portion of their future production at a fixed price. That business model lets Wheaton benefit when prices rise, without the heavy risks and costs of mining operations. And with partners like Vail and Barrick, the asset quality is top-notch. It also doesn't carry much debt, just $5 million. And it generated $369 million in free cash flow last year. The only downside? It's expensive. The stock trades at nearly 70 times earnings, and the dividend is under 1%. Still, for those looking for efficient gold exposure, Wheaton's been tough to beat. Topping the list is Agnico Eagle Mines, with an incredible 44% gain in just 4 months. With gold prices climbing on inflation fears and political volatility, Agnico has become a go-to for investors looking for safety and upside. What really sets it apart, though, is its portfolio of low-risk, high-quality assets. It's got operations in Canada, Finland, and Mexico, avoiding some of the geopolitical headaches that other miners deal with. Plus, its Nunavut assets have been a key source of growth. The numbers tell the story. Revenue more than doubled from $3.9 billion in 2021 to $8.3 billion last year. Debt is low at $1.3 billion, and the stock trades at just 24 times earnings, making it the cheapest on this list. Add in a 1.5% dividend, and Agnico looks like a solid all-around performer. So while the broader TSX hasn't impressed so far in 2025, these 5 stocks have clearly bucked the trend. From retail resilience and agricultural demand to commodity rallies and gold surges, each name here is tapping into a different part of the market and showing that there are still plenty of ways to find outperformance, even in a slow year. Which one of these stocks is on your watch list or already in your portfolio? Let us know in the comments, and don't forget to like and subscribe for more investing breakdowns just like this. Thanks for watching.